Morning, everybody. Welcome to another one of our webinars at Investonline. There in front of you is our beautiful team. We're a team of 15, growing all the time. We're based out of Newlands here in Cape Town, so our offices. And today we're taking your questions on retirement planning. Got my colleagues here, senior financial planners, Jannie Smit and Stuart, Dyer. We're going to be answering your questions. We've got 10 questions, varying from all different tax issues, one or two about the market, even some gold in that. And hopefully you're going to find this very informative. All right, I think we're good to go. Let's dive straight into it. All right, question number one. How to avoid the most common retirement mistakes? Stuart, do you want to start with that one?
Sure, thanks, Nick. Morning to everybody. Okay, just going to go through a few things briefly that we see as common retirement mistakes that people potentially do make when they're either at retirement or already retired. I think the first one is what we call liquidity, and it's just planning to have access to your money at the right time during your retirement, whether that's income as well as cash, savings, liquid capital for other major retirement expenses. Jannie is actually going to talk about that in a little bit more detail in one of the other questions. In portfolio strategy, the key issue here is structuring your portfolio correctly and optimally and adjusting for market conditions. We believe quite a lot in making sure that your portfolio is robust, putting your asset allocation in your different investment products correctly, so often more conservatively in where you're going to be drawing from, and more aggressively in the investments that you're not going to be drawing from in the near future, and making sure you're adjusting your overall asset allocation on an ongoing basis. Tax, if you've watched our webinars before, you would have seen that we speak about tax a lot, a thing we think is often overlooked and only paid attention to reactively once you realize that you're potentially not in a good tax situation and then you want to make adjustments. We think tax is something you can be proactive about and plan for in advance. And inflation, I think this is a key issue to get right, is to properly model and illustrate the impact of inflation on your money, your expenses, and your taxation over the time that you plan to be retired. So if you're about going to retire in the next 3 to 5 years, or if you're already retired, it's something we model very closely with clients. And I think you can really see how the impact of inflation when you get into your 70s and your 80s, what effect that has on your income and your capital. And I think you have to plan for that very carefully.
Right, next one. Is there a magic sweet spot ratio that you would recommend between retirement savings and discretionary funds? So here, practically here, my ratio currently is 72%, 22%, and I'm 3 years from retirement. Yeah.
Good morning, everyone. So good question. Unfortunately, there's no sweet spot ratio really between retirement savings and discretionary savings. It's ultimately tailored to each client's individual needs and long-term cash flows. One way we really go about determining what that sweet spot might be for each client is ultimately building a comprehensive financial plan to map out these future cash flows. Here's an example of a financial plan we've done for clients in the past, and we've mapped out these capital expenses that would be over and above your monthly income. As an example, factoring in home maintenance, international travel, a wedding for your child, new investment vehicles, and I think one that's quite overlooked as well is assisted living in the later years of retirement. And what the plan will always show us is where there's a liquidity problem. And what that ultimately means is your discretionary savings have been depleted. And this is where we would go and sit with the client, reverse engineer it, see how much more discretionary capital needs to be acquired, or what is maybe other areas where we can tap into additional liquidity.
Well done, Jannie. Good one. How to choose between a living annuity, fixed life annuity, or hybrid annuity? Yeah, a real common question. Stuart?
Sure, thanks. Yeah, this is a key question. I know it's difficult to know which one to select or what combination to select. So first off, just to go through what those three investment options are. So when you retire, your compulsory retirement money, which is your pension fund, your provident fund, your retirement annuities, that needs to move to a form of pension vehicle, which is generally called an annuity, and you can choose between going into a living annuity. Living annuity is a market-linked investment. So that's an investment where you actually invested, whether you invested in cash or balance funds or the stock market, but your money is invested into something. Or if you had to go into a life annuity, which is an insurance contract that pays you a guaranteed income for the rest of your life. In the case of a life annuity, your capital actually falls away in exchange for income. And what you get, what's a hybrid annuity, which the person who posed the question has asked, the hybrid annuity is a combination. It's to say you're going to take some of your retirement money when you retire, and you're going to split it between living annuity and life annuity. It's quite a common strategy. Often when life annuity rates are higher, they gain in popularity. And that was the case 2 years, 18 months ago. Life annuity rates were a lot higher because interest rates were higher. There was a lot of perceived risk in South Africa pre the national election. And life annuities were gaining more favor at that stage. But ordinarily, living annuities is where most money in South Africa is invested because you don't have to hand your capital over to the insurance company. You invest in your money and you're merely drawing from your own investment over time. So the key thing with the living annuity is to make sure that your capital is growing correctly and that you aren't drawing too much from your capital. Our view is that we generally do recommend a living annuity unless you're perhaps a little bit older and further along in retirement. The older you are, the better a income rate the life annuity companies will offer you. And just to highlight that you can go from a living annuity to a life annuity at any stage. So if you do retire at age 60 or 65, you invest your money in a living annuity, and down the line, perhaps when you're 75 or 80, you can at that point decide to sell your living annuity and then invest the capital into a life annuity. It might be suitable to do it at that stage because the income that you get that's guaranteed for the rest of your life would generally be higher when you're older. You can't go the other way around. So if you retire and you go into a guaranteed annuity at an insurance company, you can't then change your mind and get the money back in capital. You've essentially forgone that capital in exchange for income.
Okay, good. Thanks, Stuart. Right, next question. I'm worried about an impending stock market crash. Sure, please comment. Right, good question. Yeah, global markets are near all-time highs. Markets don't continue to go up in a straight line. They do fluctuate. And, the only real true measure of looking at where you are is really looking at valuation. So this chart that we've got here is the World Market Index, and this is a forward PE. And you can basically see, over the last 35 years, the market is near highs. The previous big high there you could see in the year 2000, that was the last IT bubble before the market came down significantly. But we've moved back up to near highs of near a forward PE of 20. So the market is definitely due some kind of a correction. I wouldn't say that an imminent crash is on its way, but be aware that markets are highish, lofty, and look at your investment strategy. And you've really got to see how you would cope with the market coming down through a correction of 10 or 20%. The other one to have a look at is our local market. So the SA market is on a historical basis looks cheap. And I certainly believe that there's a lot of value in the SA market. Obviously, the whole issue with the SA is the limited growth that we have in the economy, and that's what we've really got to start seeing is some improved growth. When the growth returns or there's some visibility of growth, that's when we really will start seeing a re-rating in the market. So overall, if we do see a global correction, sure, the SA market will be felt, but I don't believe that the SA market would come down to the same extent as a much more lofty global market is from a valuation perspective. Right. Okay, another market-related question. Okay, with the gold price at current levels, how much exposure will I have as an ordinary South African retiree? What risk or opportunity does this give me? Right, interesting. Gold, obviously everybody is talking about gold, and I mean, look at the gold price there. I mean, at record all-time highs, even on a inflation-adjusted basis, at a record all-time high. So gold's interesting. Certainly as a retiree, you wouldn't have had an enormous amount of gold in your portfolio, unfortunately. Most people haven't. Most fund managers have been underweight gold. The main reason is that gold is very difficult to forecast, and because of that, generally they would have an underweight position. So in short, to answer the question, you probably could have had, before gold really started moving up at the beginning of last year, maybe 1% in your portfolio, and that probably could have increased to maybe 2%, max maybe 3%. So the gold price, with a spike in like that, I mean, it is going to come down at some stage, and how quickly it's going to come down, we don't know, but often when it spikes up like that, it usually spikes down quite quickly as well. So when that does, there is that collapse back down again, you probably could have an effect of maybe 1% overall in your portfolio. So I don't think there's anything that one really needs to panic about. I know a lot of fund managers have been proactive. I know one major fund manager doesn't have any gold in any of their portfolios. They've sold it all in anticipation of gold coming back down again. But just interesting, just one or two little drivers of gold. And it's interesting to just look at these graphs. So the gold price started to spike or really got to increase significantly when central buying of the central bank started to take place. And you can see that's a graph on the left-hand side. And gold always moves with two reasons. One is fear, and that's why the central banks were starting to buy it, to diversify away from the US dollar. And then when there's real interest rates are low or turn negative, that's a fundamental reason why investors would buy. But on the right-hand side, investors were slow, and that's when the greed really came in. And you can see that on the right-hand side, ETF gold flows have shot through the roof, and that's really where the speculative gold has come in. Gold buyers have come in, and they've really shot the gold price right up. So I would be personally much more cautious on the gold side. It certainly just looks like it's gone up too quickly, too fast. Right, next question. Retirement is normally seen and planned for as a financial decision, i.e. how much money do I need to retire? How can you prepare emotionally for retirement and a sudden change in your lifestyle? Where can I get guidance? Jannie, do you think you can do this one?
Thanks, Nick. Yeah, so I think this is such an important question, and it's very often underlooked. Current studies show that between 15 to 30% of retirees will suffer some bout of depression during retirement. And this is really due to the fulfillment gap when ceasing employment. We need to understand that when working for 30, 40 years, it takes up a huge chunk of our daily lives. And work really gives us a sense of community at work. It gives us achievement and purpose. And now with 20, 30 years ahead of you, we need to fill up this gap. So this is a big topic that needs to be delved in. I always recommend sitting down with a financial planner. All our financial planners here have also been through rigorous lifestyle coaching to address this topic with clients. But maybe just some top tips for preparing emotionally is replacing work with purpose. and not just keeping busy. It's really creating structure within your retirement years on a weekly or monthly basis. It's also important to maintain and expand social connections. And as mentioned, it's important to sit down with a financial planner. It alleviates anxiety and gives you a sense of certainty as well within your financial plan. So by structuring your income, your discretionary investments, you know that the short-term needs are covered. It frees you up to focus on purpose, relationships, rather than constant financial stress.
Right, thanks, Jannie. Sure, fees, and performance. Absolutely. Please comment on the effect of fees and performance in retirement. Yeah, listen, fees are important, and I think most important to really understand them. And I mean, they do have an effect on your performance. So we've got one or two graphs here just as an illustration. So one is a 1% difference in fees. So the graph really shows, let's see, the light blue is if you have a 9% return and you're living in annuity, we assume inflation of 5% and a drawdown of 5%. But if you have a 1% higher fee and you only get an 8% return, the grey whale side, you can see how much your money comes down and depletes a lot quicker. So a 1% difference on an annualized basis will make quite a difference to your retirement. So I think it's important to make sure that you understand your fees. And I mean, I'd urge everybody to go and ask their advisor for their EAC table, your effective annual cost table, and that will set out the details of your fees. And generally, fees will comprise an advisor fee, a fund management fee, and generally an admin or platform fee. And your fees shouldn't be more than 2%. So have a look, understand them, and that's really important. At least you know what you're paying. Right, another one then is about performance. So really market, and I think often when one retires, obviously your money's extra precious, and you don't want to suffer any losses. So sometimes one can defer to just a fixed deposit, leave your money in the bank. But unfortunately, that way, you're not going to beat inflation, and your money's going to run out a lot quicker. So the example we're showing there is a return of 9% that where you would get in a retirement balanced fund, and then 6% would really a return that you would get in a fixed deposit, and that's after tax. So remember, that's all interest, and you'll be paying full tax on that interest. So, and there your money would run out a lot quicker. So I really urge all retired people to have a much more of a balanced portfolio where you have some measured risk, but that's really critical to be able to beat inflation going forward. All right, next question, how to reduce capital gains tax on unit trusts? Right, who wants to take it? Stuart.
Yeah, always everyone wants to try and be as tax efficient as possible. I think there are different techniques and tools one can use in reducing tax, capital gains tax being one of them. One thing is to trigger gains more regularly. I know quite a few investors try to avoid paying capital gains tax and let their capital grow for as long as possible, even decades, without triggering any capital gains events because they are so averse to paying capital gains tax. And depending on your marginal tax rate, often what that ends up doing is then when you do make a switch to your portfolio or you need to sell your investment, then the profit that you're triggering, which is the capital gain, can end up being a lot more sizable because you've just let that capital grow and grow and grow. And what happens is you can then end up, when you do make a sale, you're triggering a really large gain, which can push you up to the maximum tax levels. I mean, we've got clients who you can be wealthy, but if you've got your money structured between the different pillars, which I'll show you just now, retirement funds, and you use some endowment wrappers, and you've got some money offshore, you can still keep your marginal tax rate relatively low, even if you've got a large amount of capital. But when you then trigger these sizable capital gains, which can be millions or even tens of millions of rands, what ends up happening is then you're paying 18% capital gains tax on all those large gains. So one way to avoid that is to trigger gains more regularly and make switches to your portfolio, even strategically, to keep your gains at a lower marginal tax rate. Instead of paying gains at 18%, you can pay gains at 7% or 12%, or pay tax at 7% or 12%, I mean. Utilizing wrappers and endowments. So when you put your money into a wrapper or an endowment, you letting the institution become the taxpayer for the investment. And the institution pays a flat capital gains tax rate of 12% on any capital gains events that are triggered. So if you do have your different sources of income and your different growth that you have on your investments, that can be a very useful tool where you put some of your capital into an endowment or a wrapper, and you're getting that interest income, those capital gains out of your personal tax return. That gets taxed at a flat 12%, and it can help keep your marginal tax rate on your side that you file in your tax return to a lower rate. And then depending on your situation, a lot of our investors will invest, if you're a married couple, you can invest and split the capital, give some capital to your spouse to invest in their name. That way they can use their interest, income and exemption, as well as their exclusion for capital gains tax. And then you can just spread out all those capital gains you trigger going forward. Also, if you've got any trusts, you can use trusts quite strategically, depending on who your beneficiaries are, to also reduce capital gains. So there are ways across these different methods, whether it's trusts, endowments, family members, where you can keep your capital gains to be quite manageable.
Oh, good. Thanks, Stuart. Right. Is it better to take the maximum cash from your retirement fund, including excess contributions, or to use the funds to buy an annuity? So are the tax treatment of excess contributions in funds better than an endowment? Sure. Okay, Stuart, can you do that one, please?
Sure. So it's a very good question. You can see who has asked the question understands tax decisions around retirement time very well, because that's how I think of it as well. You need to, in my opinion, you need to assess what are the tax implications on any money I take out of my fund at this stage. So when you're at retirement, you can take a cash withdrawal from your fund, and depending on how much you take, that cash withdrawal is going to be taxable. And then you need to weigh that up versus if you had to take that same amount of money as income in a pension, such as a living annuity. And you can even be strategic of taking a larger lump sum than you need, because it makes tax sense to do so. So to answer the investor's question, or the person who submitted the question, I think that it can make a lot of sense to, if you've got excess contributions in your fund, it can make a lot of sense to draw it as a cash lump sum, especially if your plan is one that needs more liquidity. So we see it where quite a few clients of ours have large pension funds. They don't have too much liquid capital outside of their pension funds. In my view, then, if you've got excess contributions, it does make sense to consider withdrawing that as a cash lump sum, because excess contributions are tax-free when you draw them at retirement. The way you can really see what your excess contributions are is to do a tax simulation. So as it shows on the screen here, your tax simulation will show you exactly what your excess contributions are at any given time, and can really help you calculate your lump sum tax accurately. What we do is we can run multiple simulations for a client, put different amounts, and those different simulations will tell you exactly what your excess contributions are and how much tax you would pay on these different lump sum values. And it really can help you make an informed decision. Then to compare that and compare the tax you would pay on a lump sum to what you would pay if you had to rather have the money pass over into an annuity, is you have to go and look at what your other sources of income are when you retire. Your rental income, interest income, your living annuity or life annuity income, as well as any other incomes or capital gains you may have. And you need to try and estimate what your marginal tax rate would be. And that way we can show you, okay, if you take it as a lump sum, this is one tax rate, versus if you had to draw it as income, this is another tax rate. Everyone's plan is different, so we would have to advise on that on a case-by-case basis. And I think we've touched on this in past webinars, but it's really important to structure your investments in a logical way. In our view, you should have your investments that you draw your income from and are structured tax efficiently. And then you'll have your other investments, which are with more growth orientated, such as an offshore investment, like an offshore wrapper that we've mentioned before, where you wouldn't draw from that and you would just let that grow at a low capital gains tax rate. So we call that the 3-pillar approach. Just to remind anyone, if you've watched our past webinars, we have covered this before. It's really what we'll do when we do an analysis or a proposal for clients of ours or even new prospective clients, is we look at your personal investments, we look at your split between retirement money, discretionary investments, that includes your cash savings and your unit trusts, and your direct offshore money. And we'll come up with the ideal 3 pillars for you. And on top of that, there would be an income structure and how you would draw your income from the 3 pillars to make sure that you have a reasonable drawdown from your investments, as well as that you're tax efficient.
Yeah. Thanks, Stuart. Yeah, I mean, that's complex and really important. Thanks. Right, last questions. Can I transfer my investments to another institution? What are the costs and tax implications? Jannie, do you think you can handle that one?
I can take it, Nick. Thanks. Yeah, so just to maybe break it up into 3 parts. So with transfers, yes, you can most definitely transfer your living annuity, retirement annuities, preservation funds are all transferable between approved institutions. And we kind of get this question, a lot of people are unaware that they can actually transfer it, and they tend to sit with lots of small retirement products where it could actually just be focused or consolidated in a much more focused way. Also on tax, there is no tax on transfers. With regards to fees, there's no fees or costs applicable for transfers either. In very small rare cases, there might be a small exit or penalty fees when you're below the age of 55, but that's mostly more seen on old insurance type of retirement products.
Right, gents. Thanks. Yeah, well answered. Everybody, thanks for submitting your questions. Yeah, we've selected the 10 which we thought the most interest would be in. Just to go over our core services. Financial planning, we do the holistic financial planning where we look at your lifetime goals and your family needs. Obviously, the investment management, which is important, ensuring that you're in the right investments, in the right risk strategy that then is going to complement your financial plan. Direct offshore investing is really important. It's always important to have a portion of your money offshore. It just gives you better options to invest and then to do it properly. If you are direct, it is more tax efficient. And that's where the tax structuring also comes in. And that's obviously the one that Stuart was just talking about. Critical. Doing the tax structuring can really save you a few percent, and that can make a big difference over your retirement years. So just important just to run through really quickly just the engagement process. We have an initial engagement with you just to understand your needs and goals. Then we do a retirement assessment and evaluate your retirement readiness. And then we do a portfolio analysis. We will do a whole look through, deep dive into your portfolio, and we'll be able to have a complete consolidated analysis. We're looking at your asset allocation and obviously looking at your fees as well. And then we'll give you the feedback and we'll give you a proposal. And all of that, we do that for you free of charge. And I think it adds an enormous amount of value to our clients. Right. Thank you, everybody, for joining us. Hope you felt that that was helpful. And we'll send out this webinar in a few days' time. Thank you. Goodbye.